Imagine you make a smart investment decision. You research a solid company and buy their stock at exactly $100 per share. Look at this graph. The stock appreciates and climbs to $120, giving you a $20 per share profit. A great return. But your wealth is trapped on paper. That $20 gain is inactive equity, and it isn't generating new cash for you to use. In traditional investing, there is only one way to actually realize that profit. You have to sell off the shares completely and surrender your ownership of the asset. Traditional stock ownership forces you into a rigid binary choice. You either hold on to dead equity or you sell out entirely. Real estate investors don't face this binary. When they buy a house, they generate continuous income by renting it out, rather than selling the property. You can apply the exact same logic to the stock market. You can generate regular rent on those $120 shares while still maintaining your ownership of them. The specific mechanism that allows you to do this is called selling a covered call. When you sell a covered call, someone pays you cash up front. In exchange, you are giving them a contract, a legally binding right to buy your shares at a specific, higher price by a specific date. Executing this contract instantly transforms your passive stock into an active, cash-generating asset on day one. The immediate question is, how do you decide what future price you should promise your shares at? The primary tool investors use to make this choice is a metric known as delta. You don't need complex calculus to understand delta. Think of it simply as a weather forecast, a probability gauge for how the stock is likely to move in the future. Consider a strike price of $130 with a delta of 0.30. This means a 30% probability the stock hits $130 before expiration. If comfortable with those odds, lock in the price and immediately collect a $300 premium. Delta gives you a mathematical mechanism to dictate your own risk tolerance before you commit to the contract. Now, let's fast forward the timeline to the exact date the contract expires. At this moment, only 3 distinct outcomes can occur. In scenario A, the stock dips to $115. The $300 premium buffers the drop. In scenario B, it holds flat at $120. You keep the shares and premium, ready to repeat. In scenario C, it skyrockets, but you are forced to sell at $130. Across all 3 branching timelines, collecting that upfront premium structurally improves your mathematical baseline compared to simply holding the stock and hoping for the best. Scenario C presents a psychological hurdle. Being forced to sell at $130 when the open market is trading at $140 can feel like a loss. Let's break down the absolute math. We start at the bottom with your $100 initial purchase. Next, we add the $30 per share profit from the forced sale. Finally, we add the $3 premium, which stacks right on top of your capital gains. When you view the total math, the perspective shifts. Missing out on limitless upside is not a penalty. It is simply the cost of engineering a highly profitable, guaranteed forced win. If you zoom out from a single trade, this completely changes the philosophy of portfolio management. You replace the anxiety of hoping a stock goes up with the mathematical certainty of active yield generation. Intelligent investors treat their stock portfolio exactly like a portfolio of high-end real estate properties, structured specifically to generate monthly rent. Checking the weather forecast of Delta allows you to govern this system safely. By trading unpredictable upside for mathematically controlled risk, you turn standard stock ownership into a reliable, engineered income stream.